What if I told you that there may be a way for many of you to legally pay 0% in taxes on your ETF profits? I know, it sounds too good to be true. And yet, for long-term investors living in many high-tax countries across Europe, there's a perfectly legal strategy that could save you tens or even hundreds of thousands of euros when selling your ETFs. Before I get right into it, you should know we're exclusively talking about accumulating UCITS ETFs today. That's because these automatically reinvest dividends within the fund instead of paying them out in cash, and are thus a great way to avoid having to pay taxes on dividends throughout the holding period in most European countries. For this strategy to work, there are two important things that need to apply. First, before selling your ETF shares, you need to physically move to a European country with 0% capital gains taxes and become a tax resident there. I'll mention some interesting options in a moment. Ideally, you would do this in retirement or if you're able to continue your work there as well. And second, the country you're leaving should not have an exit tax on unrealized capital gains, or at the very least, a large tax-free allowance. Alright, before discussing how to put this plan into action, let's look at some countries charging zero taxes on capital gains from ETFs. The first one is Greece, with 0% taxes on any UCITS ETF. In case you're wondering, UCITS stands for Undertakings for Collective Investment in Transferable Securities, and pretty much any ETF you're able to buy as a European due to regulations is going to be a UCITS ETF. Even still, you can always check justetf.com if you're not sure. Number 2 is Bulgaria, which charges no taxes on capital gains from ETFs, bonds or individual stocks as long as they're traded on a regulated European exchange like Xetra, Borsa Italiana, Euronext Amsterdam, Paris or the London Stock Exchange. This means you should be using a reputable, low-cost broker like Interactive Brokers, where you can manually select the exchange you want to use for the trade yourself. You can find my link down below if you'd like to support me. To see how this works exactly, you can check out my detailed video on Interactive Brokers here next. Just make sure you select an exchange like IBIS, aka Xetra, instead of Getex as I did in my example in that video. Pay attention not to use a broker like Trading212 for this, as trades are often executed OTC or over the counter instead of going through an exchange, forcing you to pay 10% capital gains taxes in Bulgaria instead of 0. Number 3 is Cyprus, with a 0% tax on capital gains from ETFs, stocks, bonds or other listed financial instruments. And the same is true for country number 4, Malta, another lovely European island. But that's not all. We also have several countries that generally charge capital gains taxes on ETFs, but drop them to 0 after a certain holding period. Only 6 months in Luxembourg, 1 year in Slovakia, 2 years in Croatia, 3 years in the Czech Republic and 15 years in Slovenia. But here's the best part. Based on my research, your entire holding period is counted here, including when you purchase the ETF shares in your home country. As a result, they could also be excellent options to retire and sell your ETF shares tax-free. Again, as long as the country you're leaving doesn't have an exit tax, which we'll get to later. If you're wondering why I didn't mention Hungary, that's because only profits that are generated within a specific local TBSZ account are tax-free after 5 years. So the previous period doesn't count. And you can't transfer shares into a TBSZ account, so you're basically still forced to pay the default capital gains tax of 15% when selling your existing ETF holdings here. I also didn't mention Belgium, as they're planning to introduce taxes on capital gains by next year, or Switzerland, because they still pay taxes on dividends even when they're automatically reinvested within accumulating ETFs. Okay, now that we discussed some possible destinations to eliminate our ETF taxes when selling, let's see if some higher tax countries in Europe many of you are watching from actually allow us to do that when leaving. Of course, all of this is based on my own research as of June 2025, so feel free to correct me if there are any mistakes and make sure you carefully look into this topic yourself. Ideally talking to a tax advisor as well. Starting with Germany, which sadly introduced an exit tax on stocks and ETF holdings this year. But here's the thing. It only applies at 500,000 euros or more per position, meaning each ETF or individual stock is counted separately, not added up, and the 500,000 euro exemption only looks at your acquisition cost, not the current value of the shares, which could be much higher after many years of investing. As a result, it's really not as bad, and it seems like you can easily get around it by simply making sure you start buying a different ETF once you've added 499,000 euros to a single one, for example, thus staying within the exemption limit. So let's say you're about to move from Germany to Greece with a 0% capital gains tax on UCITS ETFs. Scenario A enables you to avoid the exit tax because you invested less than 500,000 euros, namely 450,000 each, into two ETFs, the Invesco FTSE All World and the Spider MSCI All Country World. But in scenario B, where you invested the same 900,000 euro total into a single ETF, you would need to pay exit tax, meaning capital gains taxes on the 600,000 euros in unrealized profits you've accumulated when moving to Greece. So try to keep these limits in mind when investing in Germany. As for Spain, its exit tax only applies if your portfolio of stocks and ETFs is worth more than 4 million euros in total at the time of departure, which I'd argue is a relatively generous limit. Meanwhile, France has a lower exemption of 800,000 euros for the entire investment portfolio of stocks, ETFs and other securities. So if you're above that amount in total, it might make sense to sell some of your shares to get below the 800k exemption limit before moving to another country. Now, Portugal wasn't as clear when looking into it, with some sources claiming a recently introduced exit tax only applies to crypto that was held for less than a year, and others arguing it probably applies to unrealized capital gains from stocks and ETFs as well. But since only crypto is specifically mentioned in the official guidance so far, individual investors holding ETFs may be exempt. If you're based in Portugal and you know more, please share it with us in the comments. As for Italy, there don't seem to be exit taxes on stocks or ETFs for individual investors moving to another European country. The Netherlands also doesn't have an exit tax yet for individual ETF investors, as they're already taxed annually on a deemed return under box 3. And the last country I wanted to mention in this short list of examples is my own home country, Austria, which unfortunately imposes an exit tax on unrealized profits. So if my wife and I were to leave the country right now, we would need to fully tax the 101,000 euros in unrealized profits we currently have on our ETF portfolio, plus some of our smaller Bitcoin holdings at a 27.5% capital gains tax rate. But according to EU law, this tax can be deferred into the future until we actually sell the shares in the other country we moved to. At the time of selling, we would then need to pay tax to the Austrian government on the portion of profits that were generated while living in Austria. It's necessary to request this deferral from Austrian tax authorities before moving though. So yes, at least from the examples I've mentioned in this video, my own country, Austria, does sadly seem to be the worst regarding the exit tax. Well, what can you do? By the way, if you're thinking about moving to another country in the future, it makes a lot of sense to pick an international low-cost broker like Interactive Brokers already now, as they operate globally. Once you move, you then simply need to update your country of residence in your account instead of having to move your shares from one broker to the next. You can find my link in the description below if you'd like to support me. Now, is all of this really worth it? That's really up to you, but the math can be pretty compelling. Let's say you have 500,000 euros in unrealized gains built up over 20 to 30 years of investing in accumulating ETFs. If you're facing a 26% capital gains tax in your home country, that's 130,000 euros you could potentially save by relocating to a European country with 0% taxes on these investments. As long as you're not facing exit taxes, of course. Now, I'd still argue this strategy works best for people who are already considering moving for other reasons, like retirement, lifestyle changes, or work opportunities. I wouldn't sacrifice your happiness, personal goals, and quality of life just to pay less in taxes, but that's just me. Still, I really enjoyed researching this topic, and I know many of you asked me if moving to a country with lower or no taxes on ETFs in retirement is an option. At least with some of the countries I mentioned, that does indeed seem to be the case right now. And if you're already living somewhere with 0% taxes on capital gains, I'm honestly a bit jealous, but happy for you nonetheless. Sorry if I didn't mention yours today. If you have any information whether or not your country has an exit tax on ETFs, please share it with me and everyone else in the comments. And please keep in mind that everything I talked about was based on my own research as of June 2025. Tax laws change constantly and there may be mistakes as I'm not a tax advisor myself, so talk to a professional before making any life-changing decisions. Now I want to know what you guys think. Are any of you considering moving somewhere else in the future to cut down on taxes from your investments? Also, don't forget to gently tap the like button if you enjoyed the video and to subscribe if you haven't yet. And since we're talking about ETF investing, make sure to check out this video on 6 costly ETF mistakes you need to avoid as a European investor, some of which may surprise you. Thank you guys so much for watching, have a wonderful day, and until next time.